In 1963, the average American family spent more on going to the movies than they did on eating at restaurants. Not per month, per week. That's how central the movie theater was to American life, not just as entertainment, but as a weekly ritual, a destination, a place you budgeted for like you budgeted for groceries. But here's what the bankruptcy of massive theater chains like AMC really obscures. The empire wasn't built on selling tickets. It was built on selling something far more profitable and far more fragile. Real estate, parking, concessions with margins so high they made the ticket sales look like a loss leader. And most importantly, market dominance through a strategy that looked brilliant in 1960 but became a financial death trap by 2000. This is the story that never makes it into the bankruptcy headlines. Not the story of one bad year, but the story of how a business model built on scarcity and captive audiences became uneconomical the moment scarcity disappeared. And how AMC, in trying to protect its empire, made decisions that locked it into an increasingly expensive infrastructure at precisely the moment that infrastructure was becoming worthless. Let's start with the numbers that matter, the ones nobody talks about. In the peak years of AMC, the 1970s and 1980s, the company wasn't primarily a theater operator, it was a real estate company that happened to show movies. The land underneath and around the theater was worth more than the building itself. The parking lot wasn't auxiliary to the business, it was the business model. Consider the economics. An AMC multiplex from the 1980s required 400 to 600 parking spaces. That wasn't a luxury. That was survival. Without abundant free parking, you weren't competitive. But parking, maintaining, paving, lighting, securing, costs money. Not from ticket sales, from the value of the real estate itself, and from the financing that made acquiring that real estate possible. A typical AMC location in the 1980s occupied 8 to 12 acres. That land, in suburban locations near highways, was expensive. The financing for that land, the mortgages, the interest payments, the property taxes that climbed every year, represented a permanent, fixed cost that had to be covered not just by ticket sales, but by every dollar of concession revenue and, in later decades, by premium seating options and other ancillary fees. Here's the critical moment. In 1960, this model was not just viable, it was wildly profitable. Why? Because the alternative to going to the movies wasn't Netflix. It was sitting at home with 3 television channels and no remote control. The scarcity of entertainment options meant that families would drive to the theater, park for free, and spend money on overpriced concessions because they had no other choice on a Friday night. The pricing power was immense. Popcorn that cost 15 cents to make sold for $1. Soda that came from a syrup concentrate sold for whatever the market would bear. A ticket that cost 75 cents generated, on average, an additional $2 in concession revenue. That ratio, ticket to concessions, was the real profit engine. But the model had a fatal assumption baked into it, that this scarcity would never change. That people would always need to leave their homes to see movies. That parking would always be abundant and free, creating a frictionless experience that kept families coming back weekly. What nobody anticipated, or rather, what the industry anticipated but chose to ignore because the profits were too good, was that the scarcity would evaporate, not gradually, catastrophically, and not because of one thing but because of a cascade of changes that individually seemed manageable but collectively demolished every assumption the empire was built on. In 1985, AMC made a decision that seemed rational at the time. Expand, double down, build bigger multiplexes with more screens, assuming that more screens meant more opportunity to capture more customers. This decision, repeated by every major theater chain simultaneously, was based on a calculation: if we build it, they will come. But what this expansion strategy didn't account for was the cost structure. A 16-screen theater doesn't cost twice as much to operate as an 8-screen theater. It costs considerably more. More staff, more utilities, more maintenance, more property tax on the expanded footprint. And all of this increased cost had to be justified by increased revenue. The theaters were built with the assumption that they would maintain the same attendance rates as smaller theaters, a fatal mathematical error. A theater that opens with 20% excess capacity is immediately hemorrhaging money. Every empty seat on a Tuesday afternoon at a 16-screen complex represents a fixed cost that isn't being covered. By the early 1990s, AMC and its competitors had built themselves into a position where they owned massive, capital-intensive properties that required consistent, high-volume foot traffic just to break even. And that's exactly when the environment began to shift. The first crack came from an unexpected direction, not from big media or streaming companies, but from the simple economics of home entertainment becoming cheaper and more convenient. A family could rent a VHS tape for $3, watch it at home, pause it whenever they wanted, and not pay for parking or concessions. The ticket price had to compete not just with the movie, but with the entire experience of not going. And here's where the real problem emerges. AMC's answer to this threat was not to reduce costs, it was to increase prices and to invest in premium experiences that required even more capital investment. Bigger screens, nicer seats, stadium seating, sound systems that cost hundreds of thousands of dollars per theater. This strategy made sense in one context. If you could charge significantly more for premium seating and premium experiences, then the higher capital costs could be justified. But it created a new problem. It made the business even more dependent on consistent high-volume attendance. You couldn't operate a multiplex with premium seating at 40% capacity. The math didn't work. By 2000, AMC and the industry had essentially doubled down on the exact model that was becoming less viable by the year. They had more square footage, more debt financing than real estate, more expensive amenities that required higher revenue to justify, and they were facing an audience that had more entertainment options than ever before and less incentive to leave home. The specific genius and tragedy of AMC's position was that they had structured themselves as a company where the fixed costs couldn't be cut without destroying the asset itself. You can't downsize a 16-screen multiplex without physically tearing it down. You can't lay off staff without reducing service. You can reduce the marketing budget without ceding market share to competitors who are, foolishly, making the same mistakes. This is the trap that nobody discusses when they talk about AMC's debt spiral. The $5 billion in debt wasn't just financial leverage. It was a structural requirement of the business model itself. Without debt, AMC couldn't have built or acquired the massive real estate footprint that generated the revenue that defined the company. But with debt, the company was locked into a cost structure that became increasingly hostile to the actual business of selling movie tickets. The irony, and it's the kind of irony that business historians rarely emphasize, is that the smaller debt-free theater chains that operated just 10 or 12 locations didn't fail because they were small. They thrived because they could operate at lower margins. They didn't need massive attendance to break even. They didn't have the same fixed cost burden. They could survive on a Friday night crowd. The theaters that are still operating today, the ones that survived the 2020 pandemic and the shift to streaming, are almost exclusively either massive premium experience venues that command premium pricing in major cities, or intimate, independent, often non-profit theaters that operate on community support and minimal debt. The middle got crushed. AMC's $5 billion in debt was the financial manifestation of a much deeper problem, a business model that had become economically incompatible with the actual market it served. And the most troubling aspect is that this wasn't a sudden shock. The signals were visible in 1995, they were unmistakable by 2005, but by then the debt load itself became a barrier to adaptation. When you're servicing $5 billion in debt, you don't have the cash flow to reinvent your business model. You don't have the flexibility to experiment with smaller formats or different revenue models. You're locked in, you're managing decline while trying to convince investors that you're still growing. It's a death spiral that looks very much like normal business operation until the moment it collapses. The decision to take on that debt wasn't made all at once. It was made incrementally, theater by theater, acquisition by acquisition, each decision seeming rational in isolation. AMC needed to compete, so it had to build bigger, which meant more debt, which meant it had to maintain higher attendance, which meant it had to charge more, which meant fewer people would go, which meant it had to expand further to compensate. Each step seemed logical, but each step locked the company further into a business model that the market was abandoning. This is the angle that doesn't make it into the standard bankruptcy narrative. AMC didn't fail because one bad year coincided with the pandemic. It failed because its capital structure had become incompatible with economic reality. The pandemic didn't cause the death. It revealed an illness that had been metastasizing for 2 decades. And the most sobering detail, every decision that led to this outcome was made with good intentions. To better serve customers, to provide premium experiences, to compete with new technologies, to maintain market share, to grow. The executives making these calls weren't reckless or stupid. They were navigating a business model that was already structurally flawed, and they were making the decisions that the model itself demanded. The real lesson, the one that matters for understanding not just AMC but dozens of other massive American institutions that seemed to collapse suddenly, is that business models can be internally consistent, mathematically sound, and fundamentally incompatible with market conditions simultaneously. And when they are, debt becomes not a tool for growth but a trap for decline. There's a complete breakdown of how theater chains actually calculated their real estate debt obligations, how they structured their debt-to-revenue ratios, and the specific financial pressures that forced the decision-making that led to the cascade of problems. If you want to understand the actual mechanics, the monthly payment schedules, the property tax assessments, the debt service coverage ratios that were driving the empire toward collapse, that's all covered in depth in the guide available in the description. Because understanding AMC's collapse isn't just about understanding one company, it's about understanding the invisible financial structures that hold up massive American institutions, and how, sometimes, the greatest threat to a business isn't competition or technology. It's the cost structure of its own success. But here's what most people miss when they talk about AMC's story. The collapse didn't happen in 2020. It happened decades earlier, in the structural decisions made in the 1980s and 1990s, long before anyone was thinking about streaming or pandemics. The real question isn't why AMC failed. It's why a company that had already learned how to survive the transition from single screens to multiplexes, from neighborhood theaters to mall-anchored complexes, suddenly found itself unable to adapt to changing economics. The answer lives in the numbers nobody was watching. When AMC went public in 1989, the company was valued at roughly $400 million. By 1998, that valuation had tripled. What changed? Not the fundamental business model. What changed was the mathematics of scale. In the 1990s, AMC and its competitors, Regal, Cinemark, Carmike, began what looked like rational expansion. A theater that could generate $2 million in annual revenue was a profitable asset, so why not build theaters everywhere? Why not increase the number of screens from 20 to 40 to 100? The answer seemed obvious. More screens meant more seats, meant more tickets sold, meant more popcorn served, meant more money. But here's what the executives building this empire weren't accounting for with enough seriousness. The per-screen economics in a crowded marketplace work differently than the aggregate economics in a growing one. When you build a new theater in a town that already has 2 theaters, you're not creating $2 million in new revenue. You're dividing an existing $4 million market into smaller pieces, you're cannibalizing your own profits. And you're doing it while taking on new debt, hiring new staff, and committing to 10, 15, or even 20-year real estate leases. Let's look at specific numbers from a mid-sized market in the early 2000s. Take Omaha, Nebraska. In 1995, there were 42 theater screens operating in the metropolitan area. By 2005, there were 96 screens. The population had barely increased. The total ticket sales for the market had grown maybe 8%, but the number of screens had more than doubled. Due to the division, revenue per screen had been cut in half. For a theater chain operating on a 5 to 8% profit margin, which was typical for AMC and its competitors, cutting revenue per screen in half didn't mean profit margins fell to 2.5 or 4%. It meant theaters started losing money, or they broke even, or they generated just enough to cover debt service but nothing more. Now, you might think if screens are producing negative or zero returns, a rational company would close them. AMC did sometimes do that, but closing a theater means taking a write-down on your balance sheet. It means admitting that the $8 million you spent to build this location 5 years ago was a miscalculation. For a public company whose stock price depends on year-over-year growth, write-downs are disasters. They signal mismanagement, they trigger credit downgrades, they make institutional investors nervous. So instead of closing losing theaters, companies like AMC held on to them, serviced the debt, and kept the lights on. Even as each month that theater operated, it was generating a net loss. This is where the real mechanism of collapse reveals itself. When you sign a 15-year lease to operate a theater for $2,000 a year, a common arrangement in the 1990s and 2000s, you are obligated to make those payments regardless of whether the theater generates revenue. If the market saturates and your revenue per screen drops 40%, you still owe $2,000 a year to the landlord. This obligation is called fixed costs, and it's the most dangerous load any business can carry. It doesn't go away, it doesn't negotiate, it doesn't care that your margins have evaporated. What made AMC's situation particularly fragile was the debt structure that financed all this expansion. In the late 1990s and 2000s, the company took on enormous amounts of borrowing to fuel growth. Some of this was straightforward bank debt, but increasingly, it came in the form of what's called leveraged debt, bonds and loans issued at higher interest rates to companies with moderate or declining credit ratings. For a theater operator, interest rates on this debt might be 7, 8, even 9%. That means on a $5.00 million debt load, you're paying $3.5 million annually just in interest. That comes straight out of operating profit. By the early 2000s, AMC's capital structure looked like this. The company was carrying about $2 billion in total debt. Its annual EBITDA, earnings before interest, taxes, depreciation, and amortization, the measure investors use to assess a company's cash-generating ability, was roughly $4.00. That means the company's debt-to-EBITDA ratio was between 4 and 5 times. In corporate finance, anything above 3 times is considered elevated risk. Above 4 times is dangerous. Above 5 times is heading toward distress. AMC was operating at the dangerous threshold, and it had very little room for error. The assumption built into this structure was that ticket sales would continue to grow or at minimum hold steady. But the forces acting against AMC's core business were building quietly through the 2000s, years before 2020 made them impossible to ignore. Home theater technology improved dramatically. DVDs, then Blu-rays, then streaming services became the norm. Ticket prices had to be raised to maintain margins, which meant fewer people could afford regular moviegoing. Younger audiences especially began shifting their entertainment consumption patterns. And the theater chains themselves had built so much capacity that even stable demand meant each screen was underutilized. This is the invisible trap. When the business environment changes slowly, over a decade, companies often don't respond aggressively because there's no single crisis point. There's no moment where management says we must act now. Instead, there's a slow accretion of bad decisions, each one rational in isolation. Add debt to fund expansion, because expansion is cheaper than declaring slowdown. Hold on to underperforming locations, because selling them crystallizes losses. Raise ticket prices, because that's easier than reducing cost structure. Maintain dividend payments to shareholders, because cutting dividends tanks the stock price. Each decision individually makes sense to a CEO whose compensation is tied to stock price and quarterly earnings. Collectively, these decisions build a structure that becomes increasingly brittle. By 2010, AMC operated roughly 350 theaters with about 5.200 screens across North America. Regal had roughly 560 theaters. Cinemark had roughly 430. Together, these three chains controlled nearly 40% of all theatrical screens in America. But the market for theatrical attendance was no longer growing. It was shrinking, not catastrophically but steadily. Ticket sales that had peaked in the early 2000s were declining. The chains had built capacity for a growing market into a shrinking one. And they had financed that capacity with debt that was callable, refinanceable, and subject to interest rate movements outside their control. What's important to understand is that this wasn't a business failing because of poor execution or bad luck. This was a business structure that had become mathematically unstable. It had built debt service obligations that were fixed and large, revenue streams that were declining or stagnant, and cost structures that were difficult to shrink because they were locked into long-term leases and union contracts. When the pandemic hit in 2020, it wasn't the cause of AMC's crisis. It was the accelerant. The structure was already primed to fail. The pandemic just made the failure visible and rapid. But this story extends far beyond AMC's balance sheet. It reveals something crucial about how American institutional collapse actually works. It's not usually because of a single villain or a single bad decision. It's because of a structural configuration that made sense at one moment in history and then became maladaptive. It's because of incentive systems that reward growth and visibility over financial stability. And it's because the people managing these institutions are often trapped inside the same system that eventually destroys them. The executives who decided to load AMC with $5 billion in debt weren't cynics or fools. Many of them believed, perhaps correctly, given the information available to them at the time, that the theatrical exhibition business had decades of life left. They saw growth opportunities. They saw competitors acquiring screens and thought they had to match that pace or fall behind. They operated inside a logic where debt was a tool for growth and growth was the measure of success. That logic worked in 1995. By 2010, it was becoming dangerous. By 2020, it was catastrophic. For a small-town operator, someone who owned 1 or 2 theater locations rather than a national chain, the dynamics were different but not necessarily better. A single independent theater owner in rural America faced similar pressures. Multiplexes built nearby drained attendance. Competition for the theatrical product, the films themselves, meant studios demanded higher percentages of ticket revenue. Costs for projection equipment, for maintaining aging buildings, for employing union projectionists in unionized markets, all rose steadily. An independent operator didn't have the capital of a major chain, so survival meant running tighter margins and accepting lower returns. Many simply couldn't compete and closed quietly, their buildings repurposed or left vacant. This is the broader pattern of American institutional collapse. The forces that make a business successful at one moment: focus on growth, willingness to take on debt, expansion beyond conservative boundaries, become the forces that make it fragile when the environment changes. And the environment always changes. Sometimes it changes slowly, sometimes it changes catastrophically, but it never stays the same. Institutions that don't build in flexibility, that don't maintain financial conservatism even in good times, that prioritize growth over resilience, these institutions don't survive the transition. What's remarkable about AMC's story is not that it failed. What's remarkable is that a company with genuine assets, prime real estate in many markets, a brand name, decades of operational expertise, couldn't navigate the transition to a smaller, more sustainable business model. The company did have options. It could have shrunk voluntarily, closed the weakest locations, rebuilt its balance sheet, and positioned itself as a premium operator rather than a volume player. It could have invested earlier in alternative revenue streams, luxury seating, premium formats, experiential offerings that would justify higher ticket prices. It could have managed its debt more carefully, maintaining lower leverage ratios even when growth opportunities seemed available. None of this happened, not at the scale needed. Why? Partly because the incentive systems within large public companies don't reward this kind of prudence. A CEO who announces that the company is shrinking even strategically watches the stock price fall. A CFO who maintains low debt levels while competitors grow faster is seen as too conservative. A board that prioritizes long-term stability over quarterly growth is often replaced. The structure of American corporate governance, particularly for large publicly traded companies, creates systematic pressure toward maximizing short-term metrics at the expense of long-term resilience. But there's another layer to this story that's worth examining. The debt that AMC carried wasn't just a management failure. It was enabled by a whole ecosystem of financial institutions, banks, private equity firms, bondholders, credit rating agencies, all of whom had incentives to keep money flowing into the theater business even as the fundamentals deteriorated. When a bank can originate a $2.00 million loan to a theater chain and immediately sell that loan to investors as a bond or securitized asset, the bank has no long-term stake in whether the borrower can actually repay. The risk is transferred. The incentive to monitor is diminished. The ecosystem rewards debt issuance, not debt sustainability. This pattern repeated across dozens of American industries through the 1990s and 2000s. Retail faced similar dynamics as Sears, Kmart, and smaller department store chains took on leverage to fund expansion that the market couldn't support. Regional airlines borrowed heavily to compete with major carriers. Gas stations consolidated under corporate ownership, which loaded them with debt they couldn't service when fuel margins compressed. The pattern was the same: growth, debt, market saturation, debt service failures, institutional collapse. The difference between a business that survives and one that doesn't often comes down to one factor: the flexibility to shrink. A business with low debt can close unprofitable locations and accept the loss. A business with high debt cannot. The debt obligations are fixed. They don't shrink proportionally with the business. A theater chain with $2 billions in debt and declining ticket sales doesn't have the luxury of becoming a smaller, healthier company. It either grows its way out of the problem or it fails. And growth was no longer possible in theatrical exhibition by the 2010s. The only options were failure, bankruptcy, or acquisition by a financial buyer willing to take on even more debt in hopes of extracting value. This is the financial mechanism that destroyed AMC and thousands of other American institutions. Not innovation. Not technological disruption, though that played a role, not changing consumer preferences, though that mattered. The core mechanism was a capital structure that was inappropriate for the business model, combined with incentive systems that rewarded those who built it and punished those who tried to dismantle it. The mechanism was, in other words, structural, and structural problems require structural solutions. They don't resolve themselves through incremental improvement or operational efficiency. What we're really examining when we look at AMC's decline is not a story about one company or even one industry. We're examining the fundamental mechanics of how large American institutions become brittle and how that brittleness becomes fatal. The lessons extend to any business carrying significant debt, operating in a mature or declining market, with high fixed costs and limited ability to adjust. Those lessons are uncomfortable because they apply to many institutions still operating today, but they're also essential, because they show us that collapse is usually not sudden, it's structural. It's embedded in the decisions made years before the failure becomes visible. And once you understand that, once you see the pattern, you can recognize it everywhere. Now let's look at what that pattern actually looks like when you examine it from the inside. Not from the perspective of shareholders or Wall Street analysts, but from the perspective of the people who actually ran these places day to day. The ones who watched the numbers change. The ones who felt the margin tighten. The ones who understood, often years before anyone else, that something fundamental had shifted. Let's use a specific example, one that mirrors the debt trap we discussed, but from a different angle. Consider a regional movie theater chain that existed throughout the 1960s and 1970s. Not the drive-ins we've explored elsewhere. These were traditional multiplex cinemas, usually owned by a single family or a small group of investors who had built them over decades. They were not heavily leveraged like AMC would become. But they operated under a fundamentally similar constraint. They had massive fixed costs in real estate, in the building itself, in equipment, and their revenue depended almost entirely on a single variable: how many people walked through the door on any given week. Here's the structure. A typical 3-screen theater in a mid-sized American city in 1972 might have had the following annual cost profile. Building lease or mortgage, let's say $30,000 per year. That's fixed, regardless of occupancy. Staffing, projection operators, ushers, concession workers, managers, roughly $45,000 per year. Utilities, including the enormous cost of climate control in a large open space, $8,000. Film rental, which was typically 50% of box office revenue, but with a guaranteed minimum per week, $30,000. Insurance, property taxes, maintenance, $12,000. Marketing and advertising, $8,000. Miscellaneous operational costs, $7,000. That's roughly $150,000 in annual fixed and semi-fixed costs. To break even, this theater needed to generate that revenue consistently, week after week, month after month. Now let's look at the revenue side. Average ticket price in 1972, $4. Average concession sale per customer, $1.50. So total revenue per ticket, $5.50. If the theater had 3 screens and an average capacity of 250 seats per screen, the theoretical maximum capacity was 750 seats per showing. With 3 showings per night and 7 days a week, that's about 21,000 potential ticket sales per week if every seat was filled. But of course, every seat was never filled. Occupancy rates for healthy multiplexes in good markets typically ranged from 40 to 60%. So let's use 50% as our baseline. That's 10,500 tickets per week times $5.50 equals $57,000 in weekly revenue. Multiply that by 52 weeks, assuming consistent business year-round, which is another false assumption we'll return to, and you get roughly $3 million in annual revenue. Against that, you subtract the $150,000 in fixed costs, leaving you with a gross margin of about $2,850,000. But wait, we haven't accounted for the cost of goods sold on concessions, the electricity that's directly tied to occupied seats, or the basic maintenance and repair costs that scale with use. Those typically consumed another 30 to 40% of revenue, so our operating margin dropped to roughly $1.6 to $1.8 million. That's a healthy margin. That's how these theaters could exist, how they could support owners and employees, and how they could slowly and carefully expand. But here's what happened to these margins starting in the mid-1970s. First, occupancy began to decline. Not catastrophically at first. A slow drift downward. From 50% to 45%, then to 40%. The reasons are familiar. Television ownership reached saturation. Home video rentals became viable, suburban sprawl meant that the walkable downtown theater lost its natural audience, aging buildings required more maintenance, and the movies themselves changed. The blockbuster model was taking shape, which meant fewer films worth seeing, but with more concentrated viewing windows. That translated to uneven demand. You'd have 3 packed weeks around a major release, followed by 6 weeks of near-empty auditoriums. Now watch what happens to the math. If occupancy dropped from 50% to 35%, revenue per week fell from $57,000 to nearly $40,000. Annualized, that's $2,104,000, down from $3 million. But the fixed costs didn't change. They were still $150,000 per year. Your gross margin now dropped to just under $1.9 million. That seems manageable. The margin is still there, but the operator is now facing a choice: cut costs or increase revenue. Cost-cutting options were limited. You couldn't reduce your lease. You could cut staff, but that meant shorter hours or fewer shows, which would further reduce occupancy. You could reduce building maintenance, but deferred maintenance is a ticking bomb. It becomes more expensive later. You could reduce marketing spend, which would accelerate the occupancy decline. So most operators rationally try to increase revenue. They'd add concession items, push pricing, maybe add special screenings or discount matinees. These worked modestly, but none of them addressed the fundamental problem. Fewer people wanted to come to the movies in the way they used to. Here's where the pattern becomes critical. If you owned this theater outright, if you had no debt, you could endure years of margin compression. You'd make less money, your quality of life would decline, but you wouldn't go bankrupt. You could ride out a difficult period, waiting for demographics to change, or for the market to stabilize. You had optionality. You could even, eventually, decide to sell the building and redeploy that capital elsewhere. But if you had borrowed significantly to acquire or build this theater, or if you'd borrowed to renovate it to compete with newer multiplexes, you faced a different situation entirely. Let's say you had financed 70% of the property cost with a 20-year mortgage at 10% interest. That was reasonable at the time, but if the original property cost was $1.2 million, your annual debt service was roughly $120,000 per year. That's now part of your fixed costs. So your real cost base isn't $150,000, it's $270,000. Suddenly, when occupancy fell from 50% to 35%, you weren't looking at a manageable margin squeeze, you were looking at a situation where your revenue barely covered your debt service, much less your operational costs. And if you had covenants in your loan agreement, which many did, that required you to maintain certain occupancy or profitability thresholds, falling below them could trigger default clauses. The bank could demand full repayment. You could be forced to sell. What made this pattern particularly insidious was timing. The decline in occupancy didn't happen overnight, it happened over 5 to 8 years. And during that time, the operator was often in denial. The previous year had been better. The previous quarter had been strong. There was a new blockbuster coming. The economy would recover. These are the narratives that allow a business to drift into crisis while the people running it still believe rescue is possible. Then, suddenly, it isn't. The margins have eroded so completely that there's no recovery path. The theater gets sold, often at a loss. The new owner faces the same structural problem with even less margin to work with. Eventually, the theater closes or is converted into something else. A dance club, a church, a retail space. The crucial insight here is that this theater chain's collapse had nothing to do with bad management or bad luck in most cases. It had to do with structural vulnerability. High fixed costs, debt service that assumed stable or growing demand, and a revenue stream that was entirely dependent on discretionary consumer behavior in a changing market. And once you understand this structure, you can see it everywhere. In small-town newspapers with printing plants that cost millions and required constant maintenance. In regional department stores with buildings that had been expanded repeatedly during booms. In gas station chains that had overbuilt in anticipation of continued growth. The pattern is, significant capital investment creates fixed costs. Fixed costs require stable or growing revenue to absorb them. When revenue becomes unstable or declines, the business has very limited options. Debt amplifies the crisis because it locks in the worst possible scenario. You can't reduce costs enough to maintain profitability, but you also can't grow revenue fast enough to restore it. You're trapped between two forces, and the only way out is to liquidate or fundamentally restructure. And by the time most owners realized this, it was too late to do either, gracefully. This is why understanding the financial mechanics of these institutions matters so much. It's not nostalgia, it's pattern recognition. Because the businesses that understand their cost structure, truly understand it, have the ability to adapt before crisis arrives. They can make hard decisions early. They can reduce capacity before margins disappear. They can experiment with new revenue models while they still have runway. But the businesses that treat their financial statements as historical artifacts rather than predictive tools almost always wait too long. And by then, the arithmetic has already made the decision for them. This is why understanding the financial mechanics of these institutions matters so much. It's not nostalgia, it's pattern recognition. Because the businesses that understand their cost structure, truly understand it, have the ability to adapt before crisis arrives. They can make hard decisions early. They can reduce capacity before margins disappear. They can experiment with new revenue models while they still have runway. But the businesses that treat their financial statements as historical artifacts rather than predictive tools almost always wait too long. And by then, the arithmetic has already made the decision for them. The AMC story, the one we began with, is instructive precisely because it's not unique, it's a template. A company borrows heavily during a period of strong cash flow, believing that the structural advantages that created that cash flow are permanent. The debt feels manageable when you're projecting out 5, 10, 15 years of steady revenue. You have a brand, you have real estate, you have market position, and then, suddenly, not suddenly, the entire basis of those projections shifts. Maybe it's technology, maybe it's changing consumer behavior, maybe it's a global pandemic that closes your doors for months, and suddenly the fixed costs that once seemed reasonable become the enemy. For AMC, that inflection point came when streaming services shifted from being supplementary entertainment to being primary entertainment. When a family could rent or subscribe to content at home for $15 or $20 a month, the theater visit, which cost $50 or $60 for two people, became an optional luxury rather than a routine outing. The company's debt had been built on the assumption that people would continue to visit theaters at roughly the same frequency as they always had. That assumption, it turned out, was no longer true. But here's what's crucial. AMC's problem wasn't that it borrowed money. Debt itself isn't a death sentence for a business. Debt is a tool. The problem was that the company borrowed money at a scale that assumed the underlying economics of the business would remain static. It created a debt structure that left no room for error, no margin for adaptation, no flexibility to experiment or to weather disruption. Consider what would have happened if AMC had taken on the same amount of debt but had paired it with a different business model. What if, alongside acquiring hundreds of theaters, the company had simultaneously invested in streaming capabilities, in theatrical production, in premium seating experiences that justified premium pricing? What if it had treated the debt not as a tool for buying more of the same, but as capital for transformation? The company did eventually try some of these things. It introduced premium seating formats, it experimented with dynamic pricing, it attempted partnerships with streamers. But these initiatives came late, after the debt had already consumed so much of the company's cash flow that experimentation became a luxury it could no longer afford. The math had already been written. The leverage that had once felt like an advantage had become a trap. This is the lesson embedded in every failed American institution whose financial story we examine. Sears borrowed to expand and modernize when mail-order and discount retailers were rising. Drive-in theaters borrowed to build larger screens and more amenities precisely as suburban living patterns and television ownership were accelerating. Small-town newspapers invested in printing presses and distribution networks just as classified advertising was beginning its migration to the internet. The pattern repeats itself across decades and industries. The common thread isn't that these companies made bad decisions in isolation, it's that they made structural decisions, debt decisions, capacity decisions, investment decisions, that assumed the future would look like a linear extension of the past. And in American business, that assumption is almost always proved wrong eventually. Now, understanding this pattern is genuinely useful if you're running a business, or if you're simply trying to understand why the institutions that shaped your childhood or your parents' childhoods eventually disappeared. And the detailed financial mechanics behind each of these stories, the actual numbers, the year-by-year cost structures, the specific inflection points where the economics shifted, those are laid out extensively in our complete guide, which you'll find in the description and in the pinned comment. That guide goes far deeper into the cost structure of movie theaters, the leverage multiples that different chains used, and how different companies made fundamentally different bets on the future. The broader insight, though, is this: leverage, debt, is often most dangerous when it's most comfortable. When a company is generating strong cash flow and servicing its debt easily, the managers and boards who oversee that company often rationalize taking on more leverage. The thinking is logical. If we can comfortably handle a debt level of 5 times EBITDA, why not take on debt at 6 or 7 times? The incremental return seems attractive, the risk feels manageable. But that thinking ignores a crucial reality. The comfort you feel servicing debt during good times is inversely proportional to your flexibility during bad times. High leverage that feels fine in a strong economy becomes suffocating in a weak one, and more importantly, high leverage that feels fine when your industry is stable becomes catastrophic when your industry is in transition. AMC's situation in 2020 and 2021 illustrated this perfectly. The company carried roughly $6 billion in debt, which was sustainable, barely, when theaters were generating $3 to $4 billion in annual revenue. But once the pandemic closed theaters and once consumer habits had shifted during that closure, that same $6 billion suddenly felt like an anchor. The company couldn't cut costs fast enough to preserve cash. It couldn't reduce its debt load quickly enough to reflect its new reality. It was, in a very real sense, trapped by its own capital structure. Other theater chains, smaller ones, less leveraged ones, survived the same pandemic in better shape. Not because they made better movies or charged lower prices, but because they had lower fixed costs and lower debt service requirements. They could sustain losses for longer, they had flexibility, they could experiment with new formats or temporary pricing strategies without those experiments threatening their survival. This is the real cost of leverage in a changing world. It's not just the interest payments, though those matter, it's the loss of strategic flexibility. It's the inability to take losses in pursuit of transformation. It's the requirement to defend your existing business model even when that model is being rendered obsolete by forces outside your control. The managers at AMC weren't stupid. The board wasn't reckless. They were operating under assumptions that had always held true. Theaters had always been where people went to see movies. That was the function, and that function had been stable for 70 years. But functions change, and when they do, the companies that are most leveraged to defend the old function are the ones least able to adapt to the new reality. Understanding this, truly understanding it with the actual numbers and the year-by-year cash flows and the specific decisions that accumulated into crisis, is valuable for anyone trying to learn how American business actually works. Because leverage and adaptation are the central tension in every mature business. You need leverage to grow, you need growth to justify leverage, but the moment growth stops or shifts, that leverage becomes the constraint on your ability to evolve. So if you want to understand not just what happened to AMC, but what happened to Sears, to drive-ins, to shopping malls, to local newspapers, if you want to trace the financial mechanics that led these institutions from dominance to obsolescence, the complete guide goes much deeper. It includes the specific debt-to-equity ratios these companies carried at different points in their life cycles, the exact operating margins that made them vulnerable, and the precise moments when management could have made different choices. You can find that guide in the description or pinned comment, and it's worth going through slowly, because the patterns it reveals apply to today's businesses just as much as they applied to the ones we've lost. The final lesson here is perhaps the most important. Every business that fails financially does so in a particular way. The collapse isn't random. It's not bad luck or market conditions alone. It's the specific intersection of capital structure, business model, and changing market conditions. And if you can train yourself to see that intersection, to read a company's debt levels and margins and revenue sources, and understand what happens when consumer behavior shifts, you begin to see American business history not as a series of unfortunate events, but as a series of logical consequences. That's the perspective we're building here at the Ledger of Lost America. We're not mourning these businesses. We're analyzing them. We're opening their books and asking, how did they actually work? What was the math underneath the storefront or the marquee or the masthead? And what can we learn from the decisions they made? Thank you for spending this time with us, learning the financial story of one of America's largest movie theater chains. If this kind of deep, slow analysis of how iconic American businesses actually worked interests you, please subscribe to the channel. Hit the like button, activate the notification bell so you never miss a new upload, and join us as we continue to open the books on the institutions that shaped a century of American life. There's so much more to understand about how these places worked, and we're just getting